Have you ever heard of the gold standard? It was a monetary system that was used by many countries in the early 20th century, where the value of paper currency was backed by gold. This meant that anyone could trade in their dollars for a fixed amount of gold at any time. But as time went on, the gold standard started to show some serious flaws. During the Great Depression, countries began to struggle to maintain their gold reserves in the face of economic hardship. Eventually, the system began to unravel in the most powerful country in the world at the time, England. As countries scrambled to protect their economies, they realized that the gold standard was actually hindering their efforts to do so. They had to keep their gold reserves intact, which meant raising interest rates and cutting spending, leading to worsening economic conditions. In 1933, the United States, under President Franklin D. Roosevelt, was the last major country to abandon the gold standard. Roosevelt made the decision after the country had experienced several bank runs and wanted to prevent a full-scale collapse of the financial system. However, the final nail in the coffin for the gold standard came after World War II. The U.S. emerged as the most powerful economy in the world, with most other countries in ruins. As a result, the U.S. dollar became the world's reserve currency, and other countries began to stockpile dollars instead of gold. This led to a situation where the value of the dollar was tied to the value of gold. But the U.S. had more dollars in circulation than it had gold reserves. It was simply unsustainable. In 1971, President Richard Nixon officially ended the convertibility of dollars into gold, effectively ending the gold standard. It wasn't just one person or one event that led to its demise, but rather a complex set of factors that made it clear that the gold standard was no longer the best option for the modern global economy. But was it a mistake to shift from the gold standard? Whether or not ending the gold standard was a mistake is a matter of debate. Proponents of the gold standard argue that it provides stability to the currency and limits inflation. They believe that the government's ability to print money without a corresponding increase in gold reserves leads to inflation and currency devaluation. Some also argue that back in the day, we were promised that by manipulating the value of paper money, we could avoid recessions, increase employment, and promote economic growth. It all sounded good on paper, but unfortunately, those promises didn't come true. Since Nixon ended the gold standard, our economy has suffered through some of the worst recessions in history. The unemployment rate has been hovering around 8.8% for the past 2 years, with little improvement in sight. Compare that to the gold standard era from 1947 to 1970, where unemployment was less than 5% and never rose above 7%. And that's not all. Economic growth has also slowed down. Under the paper dollar system, real economic growth has only averaged 2.9% a year, which is more than a full percentage point slower than during the gold standard era. This might not sound like a big deal, but a 1% difference in growth can have a huge impact. If we had continued with the gold standard era's growth rate, the U.S. economy would be about $8 trillion bigger today. That means the median family income would be around $70,000, almost 50% higher than it is now. Plus, our tax base would be approximately 50% larger, generating a lot more revenue for the government without needing to cut spending or raise taxes on working Americans. What about the promise that devaluing the dollar would improve our competitiveness? Well, that didn't work out either. In the past 40 years, the dollar has fallen in value by more than 70% against the euro German mark and the Japanese yen. And instead of having a modest net export surplus like we did in 1971, we now have a $405 billion trade deficit. To top it off, the dollar hasn't even kept its value. Today, it's worth less than 2 dimes compared to the pre-Nixon dollar. That means the average American family is struggling to save for their future, and they're feeling a lot of financial insecurity. The gold standard, on the other hand, was pretty awesome at keeping the value of the dollar in check. Between 1948 and 1967, inflation was less than 2% per year. Interest rates were nice and low, but sadly, in 1971, President Nixon decided to end the gold standard. Since then, We've seen a lot of financial crises, 12 to be exact. From the oil shock of '73 to the financial crisis of 2008, '09 to the debt crisis in Europe and the growing deficit crisis in the US. It's been a real mess. See, the thing is, without the gold standard, the value of the dollar is no longer tied to anything tangible. So its value can fluctuate based on all kinds of factors, and that's not good for the economy. It can make things really unpredictable and unstable. So when you hear people talking about the price of oil or other goods going up, remember that it's not always because the actual cost of producing them has increased. It could just be that the value of the dollar has gone down compared to gold and other things. It's kind of sad to think about what could have been if we had stuck with the gold standard. There was only one currency crisis between 1947 and 1967, and no major bank failures or Wall Street and corporate bailouts in the US. It's not a perfect system, but it did seem to work pretty well. Well, it's pretty clear now that the experiment of having a paper dollar managed by smart people has been a total failure. We've all paid a steep price for Nixon's mistake in ending the gold standard. But is a return to gold standard possible? The idea of returning to the gold standard has been gaining some traction in recent years. Advocates argue that a return to a gold-backed currency would help stabilize the economy, reduce inflation, and restore trust in the financial system. However, implementing a gold standard in today's world would not be without challenges. For one thing, the amount of gold in the world is finite, so it would be difficult to expand the money supply to meet the needs of a growing economy. Additionally, the gold market can be volatile, which could create uncertainty in the financial markets. Furthermore, the global economy is much more interconnected than it was during the time of the gold standard. Countries rely on international trade and financial transactions to keep their economies running smoothly. Reinstating the gold standard would require a coordinated effort among countries, which may prove difficult given the political and economic differences that exist. That being said, it's not impossible to return to a gold standard. Countries like China and Russia have been steadily increasing their gold reserves in recent years, indicating a potential shift away from reliance on the US dollar as the world's reserve currency. If more countries were to follow suit and stockpile gold, it could create a foundation for a new gold-backed currency system. Ultimately, whether or not a return to the gold standard is feasible will depend on a variety of factors, including political will, economic stability, and global cooperation. While it may not be a perfect solution, it's worth considering as one option for improving the stability of the global financial system. So what have we learned? The gold standard might not have been perfect, but it was a lot better than what we have now. It's time to take a hard look at our monetary system and make some changes that will actually benefit the American people.